Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Boring companies make you money. We're going to talk about some boring companies right here on The Smattering. I'm Jason Hall, and I've got the king of boring stocks on the show with me today. I got Tyler Crow here. Hey, Tyler.
There's nothing boring about beating the market. There's nothing boring about 15, 20% returns on capital. These are not boring. Those are immaculate numbers. Every company should strive to do them. And just because they're in some obscure thing like mining or aggregates or some like business to business thing nobody's ever heard of, who cares? They make a ton of money. There's nothing boring about that.
Let's talk about a couple right now, Tyler. I'm going to talk about Steel Dynamics. The name sounds kind of exciting, but let's be honest, it's a steel maker. That's not a real sexy,
not the most
business.
Dynamic business.
No, it's not, but this is a wonderful company, and I'll talk about Steel Dynamics, but I want you to kick it off. What stock have you brought to the show?
All right. If making steel is too exciting to you, how about laundry? You want to do laundry?
You must be talking about Cintas.
Cintas is one of the nation's largest, they call them the uniform company, but basically they're a laundry service, for a lack of a better term. If you have a business where you've got logoed shirts or you have uniforms that are part of your business, probably a good chance you don't have laundry on site, and that's what Cintas does. They've been doing this for decades. They're a bit of a roll-up strategy where basically mom and pop's been doing neighborhood laundry service for a long time. They perfected this in terms of this national scale. And they've parlayed the idea of like, look, if we're going to come pick up your laundry, why don't we do some other very basic things like, hey, you know those welcome mats that get really dirty and you don't want to have a steam cleaner in your building all the time? We'll take care of that. Do you need your first aid kit restocked? We'll take care of that. It's just a bunch of almost like housekeeping related stuff that's not quite part of your janitorial regular services and require restocking and just assets you don't have on site. It's been a wonderful compounder over a very long time. If we want to get into the real nitty gritty of it, it's economically sensitive because companies that use uniforms tend to be part of the economic cycles. So they're a little leveraged to that. And if I were to nitpick, 35 times earnings, not great, but this is a company that's just chugged along doing the boring things of making money. They've grown their dividend by 20% annually for the past 10 years. Very good returns on capital, good returns on equity. These are the kind of businesses that nobody pays attention to and are going to do wonderful things for your portfolio.
I want to share the returns that Cintas has generated. I'm going to go back to 2010 here. The S&P 500 over that period, 366% in total returns. If we annualize that, that's 12.3% that the S&P's done, which is well above that 8 to 10% long-term average we've seen from the market. And then we look at Cintas, the growth of the stock price alone, 17-fold returns. Factor in those dividends, and you're talking around 21-fold increases in your money, an average annualized return of 23.9%. It's been just a wonderful business doing things.
Boring about that chart.
So Tyler, I'm going to talk about Steel Dynamics here for just a minute. So again, steel making, we start talking about the nuts and bolts of it and people fall over asleep. It's not a sexy business, but there are some real technical advantages that Steel Dynamics has benefited from that have allowed it to become the rare new steel company that's been developed in this country in the past 3 or 4 decades, right? So Steel Dynamics makes steel almost exclusively using electric arc furnaces. So what does that mean? It doesn't operate these giant blast furnaces. The difference here is that they're taking either pig iron or they're taking scrap metal and they're applying an electrical charge to it to melt it instead of blast furnaces. And they're making steel products that way. Now, why do it that way? The easiest, best description is, in short, is it gives you a variable cost structure. And that is the most important thing you can do in a highly cyclical industry like steelmaking, is have your ability to bring your costs down quickly when demand weakens, and then be able to ramp costs back up as your production grows so that you can avoid the worst parts of the cycle and still make plenty of money when the cycle is very profitable. And that's Steel Dynamics business in a nutshell, Tyler.
They're a small batch producer.
You're not going to get the same massive volumes that you can get from a blast furnace. So these blast furnaces, the benefit for those is they have the high fixed costs, but their incremental margins as they get closer to maximum capacity are worth more money in profits. The problem, Tyler, is the steel industry is almost never at maximum capacity because there is so much global supply. Other supply from other parts of the world race in to fill that capacity as quickly as they can. Yeah. So this is a real competitive advantage against, frankly, an advantage of blast furnaces that it's not even a real usable advantage in the modern steel industry.
I'll push back on that a little bit. Blast furnaces can make some specialty alloys that when you're doing recycling scrap steel, you just can't do. So like a lot of scrap or that electric arc furnace tends to do a lot more like construction steel, things like rebar, plate steel, a lot what we use for construction today. But if you're trying to do like some fancy alloys, like for automotive, that's where blast furnaces try to make their money. Is basically like we can build some fancy new stuff that you can't really get from the recyclers.
I'll push back on your pushback just a little bit. That's less true than it was because EAFs have gotten better and they can do a little bit more. But it is, again, it's fair to say that is a limitation. But here's the key, and I think this is a point we can both agree on. If you were going to build a steel maker today, the first thing you would solve for is having the ability to flex your production up and down and also flex your costs down as much as possible because of the cyclical nature of the industry to create a business that can be profitable in just about any part of the market, right? And that's really what Steel Dynamics has been able to build. This is what Steel Dynamics has been able to do for shareholders since the company went public back in the mid-90s. 3,500% in total returns has absolutely trounced the S&P 500 over that period.